So on the same topic, rental income. Rental income, and I guess all the different types of it. You can have commercial as well, and residential and multi-residential. Anything that comes out as being unusual, that you would find that people don't know, that you would tell them.
Well, we have a situation right now where we have a self-employed individual who has a commercial unit right now in a very high area, and he's got a good net flow coming in, which he has a surplus income. So having said that, that could be added income to his existing existing income. So he can show that as extra income that will allow him for more growth potential and more mortgage potential, and to purchase a property that has a higher amount. So when we look at that, we have to look at the individual situation. So we can't categorize all the self-employed in one area and all the employed and salary or commissioned in a different area. We have to position each one as they are. So that's why we kind of put you in an area that we know that fits well, that will allow us to enhance more.
And also, Joe, on rental income, if you remember the example that we mentioned early on about how the different lenders factor that rental income, okay?
Yeah.
The way lenders look at rental income varies. And what I mean by that is it varies by what they factor, okay? How much they factor, how are they going to factor it, okay? And how do they look at rental income in general from a risk point of view? So when I talk about what they factor, if you're buying a property, and let's say you're buying a single family home and you're planning on renting the basement, that income coming from the basement will not be factored on your application, simply because that unit, unless it's legal, that income doesn't count. So if you're buying a property, the rental income that the lenders would typically factor is the rental income coming from legal suites, okay? So that's the what. The how they factor this rental income takes us to what I spoke about earlier, which is the offset versus the add-on method. If you have a property renting for $1,450 with expenses of $1,000, your net is $450. That $450 is used differently among lenders. Some lenders would add it on as extra income to the income you've reported on an application, and others use it differently. So that's called the offset versus the add-on method. And each has its pro and con. Now, how much do they factor of that rental income? Some may say this $1,450 we're going to take on completely, 100%. Some may say it's only 50%, and you've got the rest of the lenders between the 50 and the 100. Okay, so it is to the benefit of the investor that the application goes to the lenders who will help the investor get the most of that rental income in terms of qualifying. Okay, and finally, the risk. Some lenders add a premium to the rate if it's a rental property, and that premium could be between 20 to 25 basis points. While other lenders may not worry about that premium. Some lenders manage their risk on rental properties by reducing the amortization. So they're not offering 30 years, they may be offering 25 years, and others may be actually not going up to 80% loan to value. They can go 70, 75%. So everybody looks at rental income in different ways, and it boils down to what you're trying to accomplish and where are we taking the application. And in many times the client doesn't know all of these rules behind the scene, and they just take their application to the lender that they're familiar with without understanding what the lender guidelines are, and that therefore they run a higher chance of getting a decline. If they get approved, great, but that's where the declines happen.
Yeah. And some lenders will say, okay, we only have 2 sets of rules in renting. We'll either give you a variable rate or we'll give you a 5-year fix, but you can't get a 299 rate, or you can't get, because of like what Dalia said, it's about the risk related to the premium cost. So when a client goes into it, and we know that the client is going to buy and flip and not hold, we don't want to put you into a 5-year game plan where you're going to be charged full interest rate differential. So we would say to you, you know what, we know that the rate is higher based on the variable rates, because right now you're really not getting a appetite for variable rates. So we'll put you in a product that even if you need to get out of that product, it only will charge you the interest, 3-month interest versus full interest rate differential.